Imagine two people who earn exactly the same salary. They live in the same city, pay similar bills, and face the same economy. On the surface, their financial lives appear almost identical. Yet over time, something strange begins to happen. One person gradually feels more secure, more flexible, and less anxious about money, while the other feels trapped in a cycle of constant financial pressure, despite earning what many would consider a respectable income. The difference is not intelligence, luck, or even income growth. The difference is that one person eventually crosses a financial threshold that changes the way money behaves in their life. That threshold, for many people, begins around $100,000 in invested assets. The reason this number attracts so much attention is not because it is magical. There is no special law of economics that suddenly activates when an account balance reaches six figures. The significance comes from mathematics, psychology, and the structure of modern financial systems. $100,000 represents a point where the relationship between effort and financial growth starts to feel noticeably different. Before this threshold, progress often feels slow because most financial advancement comes from savings. After this threshold, investment growth begins contributing in a way that becomes increasingly visible. To understand why, it helps to examine how wealth accumulates. In the early stages of building assets, each dollar is usually created through labor. Someone works additional hours, develops skills, earns promotions, or creates a business that generates income. Wealth begins as stored effort. The challenge is that labor has limits. There are only so many hours in a day, and human energy is finite. This means that relying entirely on earned income creates a natural ceiling on how quickly wealth can accumulate. Investment capital behaves differently. Capital can work continuously. It does not require sleep, vacations, or recovery. When invested in productive assets such as diversified businesses, broad market funds, or other income-generating investments, capital has the potential to create additional capital. This process is often described as compounding, but the word is so common that many people underestimate its significance. Compounding is not merely growth. It is growth generating additional growth, creating a feedback loop that becomes more powerful over time. Consider a simplified example. If an investment portfolio grows by 7% in a year, a portfolio worth $10,000 generates $700 in growth. That is helpful, but it may not feel life-changing. The same growth rate applied to $100,000 produces $7,000. Suddenly, the growth begins to resemble a meaningful portion of annual savings. The portfolio starts contributing enough that the owner can actually notice its participation in the wealth-building process. This is where psychology enters the equation. Human beings are highly sensitive to visible progress. Small improvements often feel insignificant, even when they are mathematically meaningful. When investment growth is measured in hundreds of dollars, it can feel easy to ignore. When it begins reaching thousands of dollars, the experience changes. People become more motivated to save, more interested in investing, and more patient with long-term strategies because they can finally see evidence that the system is working. Behavioral economists have long observed that incentives shape decisions. Visible rewards strengthen commitment. This helps explain why many people abandon investing too early. They are attempting to evaluate a long-term system during its least impressive phase. The beginning of the journey often requires maximum discipline while producing minimum visible results. That imbalance creates frustration, and frustration frequently leads to inconsistency. The $100,000 threshold matters because it often marks the point where the mathematics become emotionally persuasive. The numbers become large enough for the brain to recognize meaningful movement. Savings efforts begin receiving reinforcement from investment growth, creating a psychological cycle that supports continued participation. There is another reason this threshold matters. Modern economies are heavily influenced by asset ownership. Most discussions about money focus on income because income is visible and familiar. Salaries appear on paychecks. Raises are announced publicly. Job titles communicate status. Assets operate more quietly. They sit in the background accumulating value over long periods. Yet historically, a substantial portion of wealth creation has come from owning productive assets rather than exclusively exchanging time for money. This distinction becomes increasingly important as economies mature. Businesses invest in technology, automation, and productivity improvements. Investors who own shares in those businesses indirectly benefit from that productivity. Workers may benefit as well through higher wages and opportunities, but asset owners participate in an additional layer of growth. Understanding this dynamic helps explain why asset accumulation often becomes a central focus for long-term wealth building. History provides useful examples. Throughout different economic eras, from industrial expansion to technological revolutions, individuals and institutions that accumulated ownership stakes in productive assets frequently experienced wealth growth that exceeded inflation and wage growth over long periods. This does not mean asset prices always rise, nor does it eliminate risk. Markets fluctuate, economies contract, and investments can lose value. However, the broader pattern illustrates the power of ownership within economic systems. The importance of $100,000 becomes even clearer when viewed through the lens of financial resilience. A person with meaningful invested assets possesses something that income alone cannot fully provide. They have options. Financial flexibility creates choices regarding career decisions, unexpected expenses, and life transitions. The existence of assets can reduce dependence on immediate income, which changes how individuals experience financial stress. Psychologists often distinguish between objective financial circumstances and perceived financial security. Two individuals may have identical incomes, yet experience dramatically different levels of financial confidence. Asset ownership frequently contributes to that difference because it represents accumulated capacity. It is a resource that exists independently of the next paycheck. This can influence decision-making, risk tolerance, and overall well-being. There is also a deeper identity shift that occurs around major wealth milestones. At lower asset levels, many people see themselves primarily as earners. Their financial story revolves around earning, spending, and saving. As assets grow, a subtle transition begins. They start viewing themselves as owners. This identity change may seem abstract, but identity strongly influences behavior. People tend to act consistently with the roles they believe they occupy. An owner thinks differently about consumption. An owner evaluates trade-offs through a longer time horizon. An owner recognizes that every dollar spent today is also a dollar that cannot participate in future compounding. This does not mean eliminating enjoyment or avoiding spending altogether. It simply means understanding opportunity cost more clearly. The fascinating aspect of this transformation is that it is rarely visible from the outside. Society tends to celebrate income milestones because they are easier to observe. Wealth milestones often remain private. Yet from a mathematical perspective, the accumulation of productive assets may have a larger impact on long-term financial outcomes than many income increases. Of course, reaching $100,000 does not solve every financial challenge. It does not guarantee future success, eliminate economic uncertainty, or remove investment risk. Markets remain unpredictable. Personal circumstances change. Financial progress continues requiring patience and discipline. The threshold matters not because it marks an ending, but because it often represents the beginning of a different phase. The most important lesson is that wealth behaves differently at different scales. Early progress can feel frustrating because the system appears slow. Many people interpret this slowness as evidence that their efforts are failing when, in reality, they may simply be experiencing the mathematics of the early stage. Compounding tends to reward persistence rather than impatience. When viewed from a broader perspective, $100,000 is less a destination and more a transition point. It is the moment when accumulated effort begins receiving meaningful assistance from accumulated capital. The shift is subtle at first, but over time it can become increasingly significant. Understanding this threshold helps explain why many investors, economists, and financial educators view it as an important milestone. Ultimately, the reason $100,000 changes everything is not because the number itself possesses special power. It changes everything because it represents a stage where psychology, mathematics, and economic structure begin working together. The progress becomes visible, the incentives become stronger, and the relationship between labor and capital starts to feel different. In a world where financial success is often discussed in terms of income alone, that shift in perspective may be one of the most valuable changes of all.